Liam Peck is a KiwiSaver and personal insurance advisor at Wealth HQ. He also has experience as an account manager at a property rental company. Liam studied in Europe, where he picked up his international business degree, but also spent a lot of time with the provinces, and in particular, Palmerston North. Liam, how did you find that well-rounded life experience help you as a financial advisor?
Well, I think the first point is obviously the business degree. Got me a bit of knowledge just about business in general. Living in the provinces, obviously humble old Palmerston North, able to connect with people that live maybe a little bit more rurally, especially in that kind of central North Island region. And then also account management, just good client relationship skills. So I think that combination just helps me build good rapport with clients and just kind of be able to facilitate that conversation quite well.
So why join KiwiSaver?
Yeah. So KiwiSaver, one of the main reasons for joining KiwiSaver is the additional contributions you're going to get, right? The first one's your employer. So they are obliged to contribute at least 3% of your gross salary at a minimum. And then you also get your government contribution. So that's $521 a year if you contribute your $1,042. So think about that over a 10-year period, $521, $5,221-ish. And then compound gains, compound returns, let's say 8% over 10 years. It's a lot of money. So huge benefits just because there's additional income that's coming to it, not just your own contributions yourself.
You mentioned your own contributions. What sort of rates are they?
So you can contribute 3, 4, 6, 8, and 10%. They're fixed percentages. So you can just jump into either your current provider or your IRD, and you can kind of just flip between them.
I can imagine contributing more will have a much better long-term effect.
Absolutely. So it is one of the magic questions I do get from clients almost on a daily basis. The ultimate question or the ultimate answer is it really does depend. So I'm a pretty big advocate for as much as you possibly can at that point in time. That's going to change over the course of your life. But if you can afford to go 8 or 10%, then absolutely great. It's going to have a great impact on your compound returns. The downside is obviously it's less cash in hand. So if contributing 8 to 10% is going to put you in a position where you can't put food on the table, you can't keep the lights on, you can't pay your mortgage, things like that, then absolutely that's not for you. Contribute your 3-4%. However, if you can, then great. Another factor is this isn't for life. You can change this. It's malleable, as our colleague Caesar likes to say. It's one of his favorite words. It's malleable. So if you can do to 8% for 6 months or a year, then great. Do it. And then if something comes along, let's say, your partner stops working or something changes, you can just log in, reduce it back down. So whatever you can at the time, as much as you can at the time, but at a minimum, obviously that 3%.
One thing most people don't know about the KiwiSaver.
So KiwiSaver is a few factors. I think the biggest one that a lot of people are surprised to hear is that your KiwiSaver funds are held in a legal trust, right? If you're with a main bank or any other provider, to be honest, it's not just a bank account with your funds in it that then gets invested. It's held in a legal trust, all right? Then that legal trust is then used to invest those funds into different companies. There's a couple of reasons why. One of the big ones is because it's held in a legal trust, if that provider goes into liquidation or receivership, they can't use your KiwiSaver funds to pay off business debt. Okay, that's a big part of why it's been structured. If your provider does go under, for example, the government has other providers lined up that then they'll get allocated, or you can choose an alternative provider. So there is a fail-safe plan. There is a doomsday plan to help protect your funds, and being held in a legal trust is one of those factors.
So how does a first-time buyer utilize the KiwiSaver?
So first-time buyers, you can withdraw it for your first-time purchase as a deposit. So a couple of factors, you need to be contributing for at least 3 years. Okay, the other factor, or another one of the factors, is you need to leave at least $1,000 in there. So for example, if you've got $10,000 in your KiwiSaver and you look to withdraw that for your first-time purchase, you can't take all 10,000 out. You're going to have to leave 1,000 in there, so your deposit will be an additional 9,000 from your KiwiSaver. There's a few factors to it. Obviously, you can't purchase a property, and even if it's, let's say, you purchase with mum and dad an investment property and then look to use it in a second property, can't really do that. There are some, there's some hoops to jump through, and there's a couple of considerations, but generally speaking, most likely not. So purely for your first home.
So other than the first home, when else can you withdraw your KiwiSaver?
So retirement, 65 as of today, as we're talking about this, is 65. So you can, when you hit 65, you can choose to withdraw it. You can withdraw it completely, or you can choose to do a partial withdrawal, or you can set up automated withdrawals. Let's say you want to take out $5,000 a month from it. You can set that up with your provider. It just depends who you're with, but it's pretty straightforward to set up. And it's pretty quick as well. They're pretty good with their turnaround times generally.
What other factors should people consider when wondering how much they should take out the KiwiSaver at retirement?
So what their current income is and what they want that to be, like a general rule of thumb that I've seen is around 65%. So if you're on 100K a year before retiring, around 60K. There's also the NZ Super. So as of today, I believe a couple combined, if you're both eligible, receive around $40,000, 40 to 41,000 combined. So additionally, that's about 10K KiwiSaver, about 10K KiwiSaver each. So, it depends on your lifestyle, depends on what you want, depends on your other passive income routes. So do you have investment properties, things like that? So a lot of factors, and it really does depend. It also depends, let's say you live in Auckland as opposed to Wanganui or Martin or something like that. Very different lifestyles, very different costs associated to those lifestyles.
So what KiwiSaver has the lowest fees?
There is a provider. I think the simple answer is it doesn't really matter. When we look at performance, obviously performance is the key word, is returns. If a provider is maybe charging slightly higher fees, but they're getting a marginally higher return that outweighs the fees, doesn't really matter. There is Simplicity that do charge a 0.25, I believe, is their base fee, which is market leading for lower fees, even compared to some of the banks in some cases. And they are a great provider, but when we look at some of the other providers, the return difference is probably going to be a little bit better, inclusive of that margin for fees. So, fees are, if there's something that does seriously concern you, that's fair enough. But when we zoom out and big picture it, the equation's pretty simple to make out, and it doesn't really matter if the difference in return is greater.
Active management, what does that mean?
Active management. So there's two different types of providers. You've got passive managers and active managers. Your passive manager is going to be like your big name bank. Essentially, banks don't make money. Banks don't prioritize making their money through KiwiSaver and investments. All right, they make a lot of their money through loans, mortgages, business debts, interest on that. So their main focus isn't going to be KiwiSaver. So they're a bit more hands-off with their approach to KiwiSaver. So it's probably going to be a bit more, just predetermined setup index funds, things like that. Whereas an active manager, they're going to be a lot more active. It's in the keys in the word. So buying and selling equity shares, taking up positions on a daily, weekly basis to beat that market average. That's the kind of main difference. Yes, there does tend to be a difference in fees for the service associated, but there's also a difference in performance, a difference in, quality that you receive from the provider.
So if you could go back and give yourself some advice, say 5 years, what would it be?
So, 5 years ago, I was in Ireland, so I didn't have a KiwiSaver, but shortly after I came, and I still know that's when I enrolled, I would have gone straight to an aggressive fund from day one. I would have maxed out my contributions. I was in a position where I realistically really could have. I had a lot of cash in hand coming in because I was living with one of my good friends and his girlfriend at the time, now wife, and paying a pretty low board down in Palmerston North. I was working there, and realistically, I could have very easily maxed out my 10% and put in an aggressive fund, and I would have been a lot further along than I am now. So that's probably my biggest piece of advice, is just to start earlier or have a conversation with someone that knew about it to get that ball rolling.
So one bit of advice then that you can give somebody that's thinking about using the KiwiSaver for a first time.
The first time, it really depends. All right, and this is my clients probably hate when I say that, because it really does. So if you're looking to use it for your first time, what does that timeline look like? Are you 6 months out? Are you close enough to look at potentially getting pre-approved with Mortgage HQ? Or are you more thinking 18 months, 24 months down the track? If you're quite close, then realistically, you want to be preserving that capital, okay? I'm not a mortgage broker, but realistically, the housing market's probably not going to shift that much in that short of time. So you want to protect your deposit, okay? So you want to minimize the big ups and downs, the fluctuations. So looking maybe towards a more balanced or conservative fund. If this is a 5-year journey, if this is like a 5-year product where you're not going to be looking for a few years, maybe you're not eligible because you've only recently joined, yeah, we'll look maybe more towards a growth fund. Okay, so it really depends on your situation, which way and which strategy is best for you.
DIY or an advisor?
Advisor all day. So there's a few services now that are coming out where you can essentially manage your own KiwiSaver. You can log in, choose your own stocks and shares that you want to pick, and that's very dangerous. It's good for certain people. However, it's your retirement and it's your deposit for your first home. I'm not a builder. I don't want to go and build my house. Yes, I know what I want from it, but I don't have the skills to put up jib and framing and lay concrete floors. I can't do it, so I'm not going to. I'm going to hire someone that knows what they're doing. And I'd like to think this situation suits that kind of as well.
There you have it. A lot to consider when building your deposit for your first home and retirement. How much do you need? What does your retirement look like? Reach out to Liam and he'll be sure to give you the guidance and the clarity that you're looking for.